All right, so we're at our multifamily meetup here in New Jersey that we run every month. Let's go in and check it out. We have Chris Jackson here tonight talking about, he has 300 units. He just closed on a 174 unit in Atlanta, I think about 5 months ago. So he's breaking it down for the group. Got a great group here tonight that came through some pretty tumultuous rain. So let's go in here and check it out.
Every week it's about them not going to contract. He still didn't call me. I had to call him. Is it time? Yes, it's time. Can you get the contract by the end of the week? And I was like, whoa, $11 million project to go into contract in a week? Hold on about that. We had to do some dancing there to not do it in the week, but my point is, I had to hustle that. He didn't come to me, even after me calling every week. So just know that that's how this got done. 62 a door, it's townhouses, $1.3 million rehab. There's about 113 units that we're going to rehab. It's stabilized. We bought it stabilized so we could get agency debt on it. But we knew that it was under market rent by about $200.
Chris, touch on that a little bit more though?
Yeah.
Can you stabilize the agency debt just for folks that might not?
Yeah, sure. It was over 90% economic occupied for at least 3 months. So we were able to get good agency debt on it, which we got fixed agency debt, 12-year, 4.9. So we knew that this was going to be a buy and hold for us, and we really didn't want to do a bridge loan on it. So we got to the point where we could do great agency debt, 75% LTV approximately. But we knew that we had a lot of upside on this. They're all townhomes. The unit mix was fantastic. Heavy 2-bed, 1.5 bath. Lots of 3 beds, 1.5 bath. So we knew that we could get the average current rent, which was around $734 when we took over, and we knew that we could get 2 beds to about $935, and then 3 beds to about $1050. So you start to bring up the average rent over about 2 years to, if I have my numbers right, I think the average rent, even with the 1-bedrooms, you're going to be in that high 8 zone. So that's a huge, you're getting a $100 average rent pump. It was a big, and we like the area. We knew we wanted to keep this asset for a long time. And the investors wanted to hang in there for 10 years as well, and that's important too. It's meant to be a long-term cash flow deal.
So was a renovation on some of the units to get that rent up?
Yeah, we're doing classic turns. Like right now, we did some classic turns because we had to get rid of some bad actors. So we didn't want to go right in and do premium $5,000–$6,000 turns right away while we're changing the signature of the property, if you will. So even with classic turns, we were getting like $80 rent pumps. So I mean, that gives you pause too. Should we be doing the premiums at all? We can put like half instead of $6,000 a unit. We can do like $2,500 a unit and get $80. So, but then we started testing the market. We started getting these huge jumps with what we call oak premiums and then gray premiums and our numbers. So we just said, for every, I forget what the math was that we said, but for every 5 units right now, we're doing 2 or 3 premiums. We still want to do the classic turns because with the exterior of the building, doing a lot of work, doesn't have a great show trail right now. We have to power wash everything. We're doing new roofs. I'll talk about some of the CapEx too, but some of the CapEx that we're doing is new roofs, $250,000. We're putting new roofs on, and we're doing something called galvanized to PVC mainline pipes replacement because it's 1974 built and there was some water leaks. So your NOI is going to start getting destroyed by water leaks, and you're serving up a better product to your next investor in 10 years when they're going to definitely penalize you for having galvanized mainline pipes underneath. And these aren't the supply line pipes inside of each of the units. This is mainline water underneath, 100 grand to do that with 27 buildings with main shutoff at each building. So we're planning ahead. So thinking about what's the next buyer going to want. They're buying in 10 years a 1974 building. They're going to be like, yo, what's up with the roofs? And they're going to be like, what's up with the mainline water? Anything pre-1983, we're starting to look at mainline water. Does it have ductile pipe or does it have PVC? If it's got galvanized pipes, it's a little bit of a time bomb for you. We raised 4.6 million bucks in about a month and a half. That was pretty crazy. That was awesome. Okay. All right. I get this question a lot, and I've been there. Like, do you start out small, or do you go big, or go home? I've been there. I'm going to say that it really depends on what role. Are you going to be the main sponsor? Do you want to be active? If you're going to be the operator, I'm going to tell you, I think you should get your feet wet in a 15 to 30 unit. Understand how it works. I think that's the way to go. I really do. I think you're going to, like, even if you're a flipper, you are going to have more experience than somebody that doesn't know it at all. I think that if you need to understand how multifamily works, and jumping into 100 unit plus is a lot. So if you're a passive investor though, like an LP, like a limited partner, I think that you can just get checks and go right into big stuff. You can also be on the passive side of the GP, the balance sheet, where you can supply the needed net worth for the properties. If you have a $10 million loan, you need to be the KPs, the key partners, the people signing on the loan, the sponsors need to basically have a total of $10 million net worth. So you do have to have some people maybe jump on and help you get there. So that's passive for them, so they can jump into bigger multifamily right away. So there's the passive side of the general partnership. There's also a liquidity component to bigger multifamily, which is, I'm going to get into that into the next one actually. So let me hold that one back. I'll talk about that in the next one. And then, if you do have smaller multifamily experience, like a 15 unit, I would say now you're being held back by what is your existing fear of confidence level. Like this is a big deal actually for like if you do have experience, I think you could go right into 100 units after that. You have a 20 unit. So it depends on where you're at mentally, and we'll go into some of that too.
Chris,
Oh, yes, sir.
so for the balance sheet, is that a requirement even for, what is that, non-recourse loan?
Yeah. Yeah, for non-recourse loan.
What was the
What was the question?
Oh, the question was for non-recourse loan, is there the liquidity requirement?
Balance sheet requirement.
Balance sheet, yes, it is. $10 million loan, $10 million net worth combined of signers.
Question,
Yep.
when you were doing the small multis, how were you handling your management?
I always do third party. Yeah, I'm not a self-manager. I've learned to manage the manager. We are asset managers.
So you have to make sure that the cash flow is definitely there so you can build in, right?
Heck, yes. Okay. So when you go big, you're going to hit some barriers. The money's bigger, obviously. You saw ours, it was like a 4.6 raise, but even if you're talking about 100 units at 50 a unit, you're at $5 million bucks. The average raise on something like that, quick calculation, you guys cross-check me, like you're going to do some CapEx work, you're probably going to need 1.6, 1.7, 30% of it. So you need more money, so you have to your network is going to now determine like, hey, do I have the ability to go out there and get 1.6? So that's going to really determine how fast you can get there. Liquidity and net worth, we can touch upon this again, just to reiterate it, combined net worth of signers has to be equal to the loan. And then also say the loan is $10 million, you need the liquidity of the key partners to be 10% of that. $10 million, there needs to be a combined liquidity of $1 million bucks. And this is not IRA. It has to be convertible stocks or cash. So you have to sometimes bring in liquidity partners. Sometimes people have high net worth, low liquidity. So it's a chess game. You have to know that you're getting into that and know how to play it. And that's also that's a barrier. Is your network, I hate to say this word, but is your network weak? I mean, I started out with a weak network. That's why I don't mind saying it. I didn't have tons of friends with huge balance sheets. And I had to go out there and develop it and just start understanding, like my track record started to allow me to bring other high net worth individuals or higher net worth individuals to come and partake. So that's going to be a barrier. And then big thing is self-limiting. You got a 20 unit property that you're doing well on, you're ready, baby, to go 100 plus. And you are going to think that you're not ready, but you are.
Not asking for myself, but if somebody has no experience, never done any landlording, never owned anything, do you think they should jump into a 20 unit?
You have to educate. Yes, asterisk.
Okay.
You have to educate yourself. And, you know, you're going to be talking, I mean, that's real money. You're going to be talking about 20 units times, let's just say, 50 a door. What are we at, $1 million? You're going to be at $350,000 equity raise. It's not child's play anymore, but I do think that it's manageable if you've educated yourself. I did. I mean, I started out as a 5 unit and then an 8 unit.
I think one point to make there too is you don't have to recreate the wheel. There's people that have done this before that you can literally just copy their systems. I mean, you'll probably talk about some mentors, some folks in the industry that you've learned from, so you can definitely do it.
Yeah, absolutely. All right. So, how I broke through this, you know, you hear this "fake it till you make it" a lot out there, but I'm not going to go in the direction that you think. It's not about the cars and faking it, and just buying stuff. You don't really have the liquidity to do it. Fake it till you make it is basically about, the true meaning is you really do have to become mentally the 200 unit person before you can take down the 170 unit. And I had to do that. It took me time. But I was in the 50 unit space. I syndicated a 50 unit. I flipped a 12 unit. I had about 120 units at that time. But I didn't think I could do it. I was kind of like, hey, can I find a 90 unit? Let's step up into this. And this 174 unit came along. And I was like, man, I think I'm here. I think I'm ready for this. And I just said, what is needed? Who are the people in my universe I have to pull together to make this happen? And I had to become the 200 unit guy in my mind. And then I was able to take down the 174 unit.
Do you think that jumping from say 15 to 50 is much different than going from a 90 to a 200, or 90 to 200 is pretty close as far as the jump?
The 90 unit space is a weird space. Just because your salaries are really high. I'm going to say that things over 100 start to get very different. And then things over 150 start to get different. I think that 90 is more like 60 unit. I do. I think a 30 to 40 unit is different than a 60 to 80 unit, but not different enough. I do think you have enough experience if you've done well in a 30 unit-ish to get into 100 plus. If you know what you're doing. I mean, if you're floundering, it's not time to go to 150 units. And then you have to be a networker. When you guys are here, this is a good thing. I wish I could tell myself starting out long ago that networking, I know everybody says this all the time, but it truly is the most important thing. You gotta build your network. Shake hands with everybody, down their names, call them, develop relationships. Your network is going to help you get there. And you have to learn how to build relationships authentically. Care about people, actually give a crap about people, and learn about them. And then what's going to happen is you develop friendships, and then you talk about deals, and then you tell them about deals that didn't work out, that you got to the closing table, or you got to the final round of bidding, and you missed it. That's how you build the relationships. And then when you get one, it's not like you're hitting them in the face with a cricket bat for the first time. You've developed a relationship with them, and they're ready for you. Hey, when you get the next one, let's get in on the deal together. You gotta build relationships. And I'm a shy dude, actually. I know that's hard to believe as I'm standing in front of all you, but I'm a computer programmer. And I grew up I was a shy kid, went right into computer programming,